Hello and welcome. I'm Josh Schimmels, publisher and CEO of the Los Angeles Business Journal. Thank you all so much for joining us for our next discussion in the series, Real Estate Trends Mid-Year Update. Today, we're going to be focusing on capital markets. Over the past several years, commercial real estate capital markets have experienced significant change. We've seen higher interest rates, shifting valuations, evolving lending conditions, and then also changing investor expectations have reshaped how owners, developers, lenders, and investors approach opportunities across Southern California. While the market continues to adjust, we're also seeing organizations adapt. We're seeing new strategies emerge and opportunities beginning to take shape for those prepared to navigate this evolving environment. Today's conversation is going to explore the forces shaping commercial real estate capital markets today, from financing and lending conditions to risk assessment, transaction structures, legal considerations, and strategies investors and owners are using to position themselves for the future. We're joined by a panel of industry leaders who are closely connected to these market shifts and will share their perspectives on what they're seeing today, what they're watching for ahead, and where they ultimately believe opportunities are beginning to emerge. Before we begin, I'd like to extend a special thank you to our partners. First, a very special thank you to our three diamond sponsors, CBRE, Logos Faith Development, and Trammell Crow Company. Next, thank you to all of our platinum sponsors, City of Lancaster, City of Ontario, Kidders Matthews, Nixon Peabody, Panko Builders, and University of Redlands, Los Angeles. Thank you all for your continued partnership. All right, with that, let's get ready and let's get into today's discussion. I'm excited to introduce our speakers. So please welcome Val Achtemeier, Vice Chair, CBRE, Sonia Nayak, Office Managing Partner, Nixon Peabody, and our moderator, Tony Haney, Director of Marketing and Events right here at the Los Angeles Business Journal. Tori, welcome, and I'm going to hand it over to you.
Hey, Val, Sonia, thank you so much for being here. Really looking forward to this conversation discussing capital markets in our commercial real estate industry. The capital markets have undergone significant change over the past few years, with higher interest rates, shifting valuations, and evolving lending conditions, reshaping commercial real estate throughout our region. To kick off the conversation, I'd like to ask both of you to assess today's market environment. What are the key factors giving you confidence in this current state of our Los Angeles commercial real estate community? Val, let's start with you.
Well, listen, we're very positive and upbeat about the Los Angeles and Southern California market. There's certainly some headwinds. I think the tax and regulatory system are headwinds, but we've got a very large and well-educated population base that has proven to be very entrepreneurial and creative. I think that creates a lot of opportunities for a number of product types. I also just think the resilience and the desirability. It's a nice place to live, right? We have fantastic weather. I think you're going to continue to see a lot of people be here, live here, and some growth. I think the logistics and industrial sector are well poised given our ports and also our population base. I think you'll see some changes in the office market, right? Maybe downtown will not be as desirable temporarily, and you'll see places like Century City and South Bay look good in Orange County, and it'll ebb and flow. I also think retail is going to continue to do really well here in multifamily. So we're upbeat on it. There's some headwinds, but we really like the large population base and the growth prospects.
Great, thank you. And Sonia?
Yeah, I echo much of what Val just said. And I think despite sort of the significant reset, right, in the capital markets, I believe that today's commercial real estate market is defined less by uncertainty and more by adaptation. We've got higher interest rates and shifting valuations and more selective lending, which have required owners, developers, lenders, investors to just rethink how projects are financed and structured, but it hasn't necessarily stopped projects from moving forward. Transactions that may have previously worked in low rate environments now require stronger fundamentals, more conservative underwriting, clearer path, right, to execution. And while that has made the market more disciplined, that discipline, at least in my view, is a healthy development, I think, for our marketplace, our commercial marketplace, long term. And I think what gives me confidence in Los Angeles as a marketplace are many of the underlying fundamentals that Val just sort of stated. The region continues to benefit from a large and a diverse economic base. It's got, a significant educational and university, therefore producing a large talent base. Its diversity of experience, diversity and multicultural sort of socioeconomic base also lends itself to economic development. And so I think with all of that taken together, we're seeing the marketplace adapt, not necessarily remain in a frozen state. I think it's just recalibrating it.
And feeding off that, how our market really has to be rethinking how they're moving forward. Interest rates really have been one of the biggest driving changes in the industry over the past few years, influencing financial decisions, their transaction activity. So Val, how have these higher interest rates really changed the conversations you're having with your clients? I think you're still on mute.
Well, clearly we're in a different interest rate environment. Really for years, almost decades, we were generally in a declining interest rate environment. That kind of hit the trough in 2000 when interest rates were almost zero during COVID. And in some ways that benefited a lot of commercial real estate properties because there was some correlated cap rate compression on certain asset types and certainly very accretive financing. What we're seeing now is more of a normalization of the index rates, because we need to separate the index rates, which is, traditionally treasury rates for fixed rate debt, and then the SOFR rate for the floating rate debt. There's also this credit spread component, and index rates are up across the board. It's interesting. The one index rate that has declined a bit over the past year is actually the SOFR. So the floating rate is looking a little more desirable right now. It's around 3.67. You've got a lot of our clients that maybe historically would have looked at placing 10-year debt on a lot of their assets. We're seeing a lot of our clients really look at their business strategy and in general go shorter, not always floating, but certainly a shorter or intermediate debt. They're liking some of the SOFR rates for optionality because they don't get stuck with prepayment penalties if they want to sell or refinance or their business plan pivots. So we are seeing the yield curve get a little flatter right now. In the last year, you've got the 5-year treasuries up about 45 bips, whereas the 10 years up a little bit less. So we're seeing, some flattening of the yield curve. We're seeing a lot of groups want optionality. The one thing I would say is for certain property types, there's actually a lot of liquidity. There's been so much debt raised and funds raised to really finance all different types of properties across the capital stack. So financing is a combination of available liquidity and proceeds plus pricing. We are actually, in my opinion, the debt markets are ahead of the equity markets for many property types right now. Office might be an exception that struggling office is still having some challenges, although there is debt available. So we're seeing investors really look at their business plans, in general, go shorter. Optionality is key, and really having to realize that the success of their project is going to be dependent on operational expertise and business strategy, and not so much kind of getting saved by a really low interest rate environment.
Thank you, Val. And that really leans us into Sonia. Would you like to piggyback off that?
I would. Thank you. I think what both borrowers, investors, lenders, sort of all the key players in capital markets have finally settled with is the reality that this marketplace of 0 to 3% interest rates is not necessarily the norm. And while it was for perhaps a more extended period of time that we've ever seen in the last 50 years, let's say, of the country and marketplace, where we are settling is perhaps more historically more of an average of where the marketplace has been. And so because of that, I think borrowers are becoming more prepared, a little bit more conservative and more focused on flexibility. We're definitely seeing lenders revert to not necessarily a post-2008 kind of underwriting protocol, but they are peeling the layers of the onion back perhaps a little bit more than they were even 5 years ago. A little bit more detailed analysis about debt service coverage ratios and how they're going to be maintained, tenant credits and lease sort of scenarios, insurance costs, especially in California right now, right? The landscape across insurance is one that's rapidly evolving, and that's a key sort of consideration into the underwriting and overall viability of how a project flows cash flow and is able to service the debt, operating expenses, obviously. And so just borrowers who can provide, I think, a thoughtful, well-supported answer to their lender, to their investors, right, are going to be more successful in getting projects off the ground. I think also just the fact that a project doesn't have the lowest interest rate, or a borrower may have competing sort of term sheets, and it may not necessarily go with the lowest interest rates, because I think what has happened is by not having this 0 to 3% sort of marketplace when it comes to interest rates, borrowers are paying closer attention to other key terms and flexibility that may be offered in their debt instruments, whether that's extension rights, cure rights, cash management rights, transfer restrictions, and carve-outs such as that are playing more into what I'm seeing in terms of negotiations across debt instruments these days. So I think that, borrowers are sort of wising up to valuation and the interest rate sort of marketplace, and then adapting their deals and how they're presenting their deals to lenders and investors accordingly.
Yeah, thank you. And Val, as these conditions continue to evolve and lenders and investors and owners are evaluating, there's risk. And so how are they looking at this differently than maybe they did a few years ago?
Yeah, I think in general, it's less of a go-go environment, right? In a declining interest rate environment, there was a lot of hope that your cap rate would be declining upon your reversion and your sale. And, the economy was still performing, your NOI would also be going up. So I think there's definitely a focus that you can't really concentrate on the hope of cap rate compression and or really, really cheap and accretive debt to deliver your returns. As such, I think there is more of a focus on risk and reward. How can they mitigate risk? What is their business plan? And it ties a lot to access to capital, not only debt capital, but equity capital, right? And so I think the most successful investors today tend to have a good capital stack, a good plan, and access to capital, which is right now, capital has changed so much. It's less family office and individuals and a lot more funds and institutional capital, one way or the other, either directly or indirectly, backing a lot of these projects. So your track record is super important. I think there's been a lot of focus on really zeroing in on variance analysis of deals they've done and how their track record can sell. It's interesting. There's so much debt and equity capital out there, but a lot of the big fundraising has been somewhat concentrated on some of the larger, more successful groups. So fundraising has been a little harder for some of the smaller groups, not all certainly, but access to capital is key, looking at risk, making sure you've really got a good operating strategy and a good team to execute that, both internal and external. So I do think there's been more of a focus on risk as there's been some resets. And then certainly the capital plan. Do you have enough money to really execute the business plan that you need?
Great. And along with these market conditions, property owners and investors are navigating a more complex legal and regulatory environment as well. So, Sonia, from this side of the field, what sort of compliance issues are creating the greatest uncertainty today?
Well, I don't think there's one issue that's creating the greatest uncertainty, but I think if we had to categorically look at one, it would be local regulations are a significant factor, right? We're still dealing with transfer taxes, rent regulations, tenant protections, affordable housing requirements, entitlement timelines, permitting processes. All of these affect value, timing, feasibility, your cost of capital ultimately by the time all of this comes together. And so even when you understand how all these are going to come together and what the deal looks like, that can still have at the end of that process a significant impact on the investment decisions that are being made. Similar to local regulation, but perhaps stems beyond just the local city and county and more statewide, or land use and entitlement risks are also central concerns. We've got, a higher rate environment, and so time is just more expensive. So delays in entitlement, delays in environmental review, community approvals or agency approvals, right? Permitting, all of that can impact the economics. And then I think, as I alluded to earlier, I think the third sort of category here is just insurance and climate-related risks are receiving heightened attention as well. In California, as we all know, wildfire exposure is still a significant consideration now when deals are being underwritten, flood risk, seismic considerations, right? We've all been reading about how the San Andreas has gone silent, and we should all be in fear of what is about to happen or may be happening in the future. So that will just continue to lend additional sort of focus on seismic considerations, depending on, especially if you're doing rehabilitation deals or where projects are located. And then the availability, more significantly or fundamentally, of just whether or not insurance is available right now in the marketplace, I think is a significant consideration. And so I don't think we can say, at least when looking through the legal lens, that the greatest uncertainty is a single legal issue. It's sort of a combination of these various issues when put together can impact, the viability of a deal or a project moving forward.
Thank you. Yeah, definitely a lot to consider here, and it seems to be no straightforward answer. But as we've talked about the broader conditions, these trends often become clear through individual transactions. So, Val, is there a certain transaction or financing structure that you've worked on recently that really reflects today's market, something that maybe would have been difficult or perhaps unnecessary even just a few years ago?
Yeah, and I'm going to answer that first. Generally speaking, there is a lot of liquidity in the debt markets right now. It's kind of a have and have nots, right? Kind of across the country, not just in Southern California. Our practice is national. So while we're based here and a lot of our clients and projects are here, we're seeing a national focus on everything. One thing that we're seeing is, while development and construction starts are really disciplined right now, we are seeing a lot of construction get done, but in a very risk appropriate manner. So I think I looked at our stats. Our team's done about $3 billion of primarily industrial and logistics financing. So $3 billion is a lot over the last couple of years. That's more than we would have seen, a few years prior. Very, I think, risk appropriate, really looking at supply demand fundamentals. So a lot of those construction loans, we just closed last week a hotel construction loan in Sedona, Arizona, that would have been hard to do 2 years ago. But right now, we had a good borrower, we had a good business strategy. Certainly was time consuming, but we're seeing that. The other thing we're seeing is large transactions are returning. Particularly, we're seeing a lot of large portfolio transactions on the industrial side, some of which aren't even marketed right now. They're sent out to 2 or 3 select groups. They're called off-market transactions, and they are achieving very good financing as well. The SASB market is really open and super efficient, which really works well for large transactions above $250 million. So we've got some of those that we've been working on. So I would say in general, a couple of, construction loans in general that for a while there was some reservations about doing new construction loans in the industrial logistics sector. We've gotten a lot of those done. We've done some hotel ones, and then also the large SASB transactions and a lot of off market large industrial sales that my partners are doing as well. So, it's good. I think the markets are open. Our sense is, at least in the industrial and logistics center, a lot of really savvy investors are thinking we may be bouncing around the bottom in terms of value. And so it's kind of a time to buy. You want to go where the puck is going, not where it's been. And so we're seeing good investor appetite in general for the right composition of assets.
And staying on that, investors really keeping where the puck is going. Sonia, we're hearing a lot of conversations here about distressed assets, workouts, recapitalizations. What trends are you seeing emerge that owners and investors really should be paying more attention to?
I think the market is seeing an increased activity around distressed assets, workouts, and recapitalizations. However, I think it's important to distinguish between these different types of distress, if you will. Some assets are just fundamentally impaired. The underlying business plan just may not be viable. The debt just may not be sustainable, and there may not be any more equity to infuse into these projects. Other assets, however, remain fundamentally sound, but they are burdened by a capital structure that no longer fits the current capital market. A loan might be maturing and needing refinance in a difficult environment where interest costs, have moved significantly, perhaps from when a loan was originally taken out 5 years ago, 3 to 5 years ago even, or a sponsor just may need more time to complete leasing development or repositioning. And so understanding that distinction then drives the solution, right? So for some assets, it's a loan modification, a maturity extension, sort of that flexibility that we talked about earlier when it comes to negotiating your debt instruments. For others, it may be just revisiting the equity infusion into a deal, preferred equity versus mezzanine financing. I'm seeing an increased amount of JV deals that are coming across my desk, a loan sale, a deed in lieu, and occasionally even a foreclosure and a sale process. And so I think owners and investors focus on sort of the following three considerations, right? One, start the conversation early. When you have a loan that's coming due, when you're about to run out of capital. Waiting until that date is passed or is imminent is not going to help anybody that, a developer, a borrower, a lender, an investor. Second, I think from a legal perspective, right, they need to understand what their governing documents say. What do the JV documents say? What do the equity documents say? What do the loan agreements and, more importantly, the guarantees say? And then third, be realistic about valuation, right? Especially if we're talking about a workout or repositioning sort of scenario. Successful workouts depend on credible assumptions and a practical path forward. Optimism alone is not a strategy, right? And so if you come to the table with a practical sort of path forward, that's going to help things get done in just a more expeditious manner.
And Sonia, I might add, just in my years in the market, historically, there was a point in time where a lot of investors were really motivated to keep the loan in place and never give a property back, for reputational risk or whatever. And sometimes it was their own personal money. There may have been tax consequences if they gave an asset back. And we've been doing this for a long time. There's really a change right now, the concept of not putting quote unquote good money after bad. And a lot of these are funds or institutionals and maybe a fiduciary where you're using some other people's money in a co-invest type project. So it's interesting. I've just seen a real shift where there really is an analysis. I think most people obviously try to keep the loan current if there's a problem, but there's not really a motivation to put a lot of good capital after bad if they think that it's not going to make money and be sound. And so it's not that they're bad people, but there's really an analysis as, is this sound? And we've got a fiduciary to our investors as well. I don't know if you're seeing that as well.
No, 100%. I mean, I think, all of that is contingent on how flooded the marketplace is with a particular type of asset. If you look at an '08 or maybe even, post a 12 where there was a blimp, and certainly during COVID, right, lenders and investors, because the marketplace was just flooded with sort of assets that were distressed, were willing to sit on them a lot longer and work with owners or developers. I agree 100% with what you just said, Val, in that while I am seeing lenders or investors initially say, okay, we're willing to work with you and here's a little bit of runway, it's certainly not, we're going to continue to just extend. There is a end point for developers and owners to figure it out. And if not, then I'm seeing lenders and investors move forward with exercising their rights under their respective documents.
Great. And obviously we've talked about, there's a lot of risk going on. There's a lot owners and investors really need to be navigating right now in the market. And some organizations are clearly doing that a little bit better than others. So Val, what's really separating these organizations who are successfully adapting and those who are maybe struggling a little bit?
Right. And we have a lot of different clients. So we have a lens of seeing a lot of different versions. I still think access to accretive capital is really important, right? You can have a great idea and a great business plan, but if you're having a hard time pulling together the equity and or the debt, it's difficult. So think a savvy business strategy, really looking at the supply demand fundamentals and where you're going to position that asset in the future. Vision, favorable market conditions are really important, right? Sometimes people can stay with a certain formula or a certain geographic location for their operations, even though maybe the market has shifted. I think a talented team is really important. And I think that's changing. Diversity is important on teams. For a long time, we were made up of a lot of homogenous people on a team. I think we're figuring out having financial and legal and development and marketing expertise all woven in is really important. So a good team composition, as well as I think utilizing effectively outside advisors, whether that's legal counsel or brokers or whatever. And then I think just, the hard work and resiliency is important and a little bit of luck. I will say we are seeing AI influence our market really quickly. I think it's generally good. It's going to lead to a lot of productivity gains, but like anything else, we have to adapt. I think critical thinking is really, really becoming important, and you have to really watch pushing projects down too far down the totem pole without having the right kind of supervision and critical thought if you're doing a proposal or a presentation or looking at joint venture documents or whatever. So I think AI is a great opportunity. It really is going to separate people and organizations that can use that information effectively and productively. And to me, critical thinking is a lot of that. So you still have to really know the market. You can't just throw something in AI and think it's going to solve all your problems. But those are some of the things that I see.
Great. And Sonia, bringing it over to you, critical thinking, strategic considerations. These are all things that owners and investors really need to keep at the front of their mind at all times. So what opportunities and managing risk, what does that look like for these investors and owners in today's market?
So I think some of those items we've already touched on, right? Like just understanding what the process is, what approvals are going to be needed across the board, and how that plays into the project's timeline and therefore ultimately cost of capital along the way. What we haven't talked about, I think, outright is that I think this concept of basis is also critical. Understanding the valuation of the asset that is being purchased and leaving room for perhaps some uncertainty in the marketplace or within the deal is is, I think, critical. So investors or borrowers, developer sponsors who acquire or recapitalize asset at the right price point, at the right basis, therefore then have room to absorb that uncertainty. So that's something I don't think that we've touched upon yet during this discussion. I think transactions that are relying on aggressive rent growth, rapid lease up, just face a higher cost of capital carrying risk along the way. And then I think flexibility is equally as important, right? You can't just have a plan A and only a plan A, and we're not going to be able to pivot. Understanding where some of these pitfalls may occur along the way and having flexibility in how a project moves forward, I think is more important than ever right now in this current marketplace. And so I think it's not whether, a deal can work today, but understanding what the variables are: zoning, entitlement, permitting, compliance, environmental insurance, all of those things. But the valuation component and having a little touches on, I think, what Val concluded with. I think the quality of partners matter, right? Having experienced, whether it's lenders, investors, advisors, attorneys, your brokers, right, who understand that this current marketplace is a complex one and are solutions-driven practitioners and partners to these deals, I think are, when taken all together, all critical.
Great.
Val, bringing it over to you, institutional investors are often an early indicator of where the market may be headed. So what are these institutional investors really paying attention to today that owners, developers, operators in LA really should be watching?
Yeah. So institutional investors are very sophisticated and savvy. They really do a great job of portfolio and asset management. They look at a lot of variance analysis of what's happened in the past. One thing we're seeing is that they're incredibly focused on data, but current data. Right now, there's so much information available, but you can't have it be stale. It has to be really relevant to the project because everyone's trying to predict in the future what kind of cash flow are you going to have, what's going to happen with rents, what kind of capital do you need. So they're really looking at what the market is doing. So supply demand fundamentals are really important. And they're using this data to really develop the best business strategies and learn from things that have worked for them in the past and that maybe didn't work. I am seeing for the institutional side, there's more of a focus now on cash returns, right? For a while, it was kind of just focused only on appreciation. And I think they're kind of looking at it somewhat as a fixed income kind of opportunity with upside potential. So they're trying to make sure that they've got decent cash on cash coming on in near term. For a while, that wasn't really a focus. And they're definitely focused on the valuation forecast, the 10-year or 5-year cash flow and where they can really get those kind of returns that they need, depending on the risk profile that is, whether it's core plus, or value add. So very sophisticated, looking at data, really looking at the market, looking at competitive projects and potential new supply and where they can really compete. There's a lot of focus right now on what kind of rents are achievable and where expenses are going, as Sonia mentioned, right, depending on the product type. So a lot of analysis on what they think the cash flow is going to look like, both from a revenue and expense and a capital perspective.
Great. And Sonia, let's take a look at the next 12 to 24 months on your end. What indicators are you watching most closely? And what do you think that tells us about the direction of the market?
Well, I think the obvious answer to that is interest rates will remain central and critical to the analysis, but I don't think the practitioners or developer sponsors, investors stop with the headline rate, right? It goes into what Val was talking about earlier across looking at the different types of rates, looking at and monitoring lender spreads, reserve requirements, and underwriting standards. I think in addition to just the interest rate analysis and focus, debt maturities, I think, will also be a key indicator, right? Many loans originated in a very different rate environment, and now they are coming due, and how those maturities are addressed, whether it be through refinancing, extensions, modifications, sales, recapitalizations, or enforcement actions, will be telling about asset values in the commercial marketplace and lender and investor confidence. And then again, in LA, regulatory and policy developments around housing, around transfer taxes, adapted reuse, permitting, tenant protections, all of those categories will continue to be highly relevant and have a determinant factor on productivity in those types of transactions.
And we are down to our final question, which I'm going to address to both of you. So throughout this conversation, we've talked about challenges due to higher interest rates, tighter lending standards, shifting markets. So as this market continues to evolve, where do you see the greatest opportunity, and what should business leaders really be paying attention to? Val, let's start with you.
On the real estate side, we continue to see opportunities. Personally, I believe that e-commerce is going to continue to grow and expand exponentially. I think that's a real positive for large logistic buildings. I think you're going to see more and more shopping done online, and you're seeing really great opportunities to team up with some of those users. Some of them want to lease, some of them want to buy. Certainly Amazon and some of the e-commerce players are big operators that are creating a lot of momentum. I'm a big fan in Southern California for logistics and e-commerce projects, particularly the larger ones. I think you're going to continue to see that there. I also think you're going to see experiential retail continue to perform, as well as grocer anchored. I think some of those community centers are going to do well. Certainly malls are kind of going through an evolution, but I like the grocer anchored and experiential kind of food oriented, although it's capital intensive. I think you're going to continue to see those opportunities do well. Office is kind of a mixed bag. There's winners or losers. I think you've seen a lot of owners really know how to pivot. Century City is a great example of that, where you really have seen incredibly good demand that's been met by savvy owners and developers of creating an environment where people want to be. So I think you'll see some opportunities on the office side that really work, and some that continue to challenge. But we particularly like the e-commerce and logistics for the larger users.
And Sonia.
Right. I think in Los Angeles, long-term demand will continue to focus and support opportunities in housing, and specifically multifamily and affordable housing, adaptive reuse, healthcare adjacent real estate, transportation-oriented development, and select sort of mixed-use projects will continue to just be a focus and a strong asset classes across the board. This is a marketplace that rewards patience. It rewards creativity, discipline. It's definitely a market that's more complex of years ago, but I think that complexity will create more meaningful opportunities for owners and investors who understand the legal structure and underlying real estate sort of fundamentals of these various asset classes.
Well, Val, Sonia, thank you both so much for giving our listeners such great feedback to take back and, really think about with their organizations as they look through their capital market strategies for the next year. So thank you both so much for being here. And Josh, I'll hand it off to you.
Well, that formally concludes today's discussion in our Real Estate Trends mid-year series, which was focused on capital markets. I think you'll all agree, fascinating discussion. There's really a lot to think about. Tori, I want to thank you so much for guiding today's conversation. Val, Sonia, thank you both for sharing your expertise and for offering invaluable perspective on, again, the challenges and opportunities that are shaping today's commercial real estate environment. I think it's clear that while the market continues to evolve, Organizations who are watching programs like this and they're listening to conversations and they're remaining informed, they're also becoming adaptable and very strategic in order to best position themselves for what comes next. I want to thank all of our partners again for making this possible. We can't do this without you. And we hope that you continue the conversation all by tuning in to all of our discussions this week on Real Estate Trends Mid-Year Series. We're also talking about the office and industrial market. We're going to take a look at the brokerage side of that. We're going to have an entire panel on economic development, design, and construction. And then, of course, we're going to take a look at the future of development through innovation, AI, and opportunity. And then lastly, as a reminder, we wrap up this entire series with a recap within the Los Angeles Business Journal's August 3rd edition, where you're going to have an opportunity to read additional insights, Q&A responses from all speakers from all panels, and then take a look at what the comprehensive picture looks like shaping Southern California's commercial real estate market. Thank you all for being a part of this and for tuning in. We'll see you next time.